Welcome back. You're watching The Farm. Now, it's been dubbed the Google tax. Starting April 1st, UK will levy a new diverted profits tax. This is the British government's offensive against multinationals such as Google, Amazon, Starbucks and many others accused of shifting profits and avoiding tax in that country. And in doing so, UK will become the first country to implement the OECD BEPS action plan ahead of the OECD itself. Ayush Elavadi reports on how this new tax will work and the precedent it will set for other countries.
Our new diverted profits tax is aimed at large multinationals who artificially shift their profits offshore. I can confirm that we will legislate for it next week and bring it into effect at the start of next month.
The UK is the first to launch an offensive against large profit-shifting multinational corporations such as Google, Starbucks, Apple and Amazon. Starting April 1st, UK will levy a new diverted profits tax on MNCs that do business in the UK but avoid paying tax.
They avoid a tax in two ways. The obvious way is to avoid having a permanent establishment here but still generate UK business profits. So there being a big difference between business profits and taxable profits. And the second was to have taxable operations in the UK, but to reduce your profits by ensuring that generous tax deductions were available by virtue of the tax entity in the UK making payments of royalties to affiliates located offshore in tax havens. So these are the two things which the DPT addresses.
The Diverted Profits Tax, or DPT, acts by imposing a 25% tax on large MNCs in two situations. First, on arrangements to avoid a UK permanent establishment.
A company that, say, is selling a lot of goods or services in the UK, and it has a lot of people who are really salesmen in the UK who are asking customers to enter into contracts, but then technically at the last minute they don't sign the contract in the UK, they do that overseas. Under existing rules, you can argue they don't have a taxable presence, and under the new rules they would probably be caught if they did that.
The 25% DPT will also be levied on arrangements that lack economic substance, involving entities with an existing UK taxable presence.
It's the second part of the legislation which is much less clear, and that's because it requires a payment going to a company that lacks substance, but substance is defined as, or rather lack of substance is defined as being where the tax benefit is greater than any other benefit. So if you think about it, you could have a company with people actually doing, real people sat in that company doing their job, actually producing whatever it is, managing intellectual property, let's say. But if the tax benefit is greater than what they're adding, then you would be caught. And it's very difficult to actually see, well, how do you do that balancing act? How do you say which is the greater benefit, a tax benefit or the other benefits that are produced by the structure? That's where I think there's a lot of uncertainty.
Economic substance is a hyper-litigated concept in Britain and around the world. This application of a punitive tax surprisingly preempts OECD's efforts in the same direction. It raises cross-border issues as well.
There is also another issue under European law if the other affected party was within the European Union, because the European Union has rules that say you can't apply anti-avoidance rules to a structure unless it's purely artificial. And one of the big question marks over this legislation is that it applies to structures which are not purely artificial.
The HMRC, UK's Tax and Customs Authority, says that the new tax will apply on profits arising after 1st April 2015. The draft legislation placed an obligation on the MNCs to notify HMRC if they may be subject to the tax, though that might be amended in the coming week. In many cases, the 25% tax has to be paid upfront and cannot be postponed pending determination of any appeal.
My own view is that this DPT, in fact, will turn out to be a deterrent as opposed to a tax-gathering mechanism. So my name for it, if you like, is I call it the deterrent profits tax, because the fact of the matter is that if you have multinationals going forward who find themselves coming within the DPT, that automatically will brand them as profit diverters, so far as the UK is concerned. And reputationally, there is an issue here for such multinationals to be seen to be people paying their proper share of UK tax while at the same time exploiting tax advantages which are properly available in the UK?
I think in some ways this is a tax that's designed never to be paid. So it will be effective in that it will mean that companies that have structures where they clearly would be caught, so if a company knows it's really been structuring itself to avoid having a taxable presence in the UK, they'd be very well advised now to restructure, make sure that they pay corporation tax at 20% and not diverted profits tax at 25%.
The UK's tax department estimates that this new diverted profits tax will raise £300 million a year. That's still a fraction of the profits that MNCs are making in the UK. But in an election year, plugging the loophole sends out a strong message. This is a tax on avoidance, and since most of Britain's existing double tax avoidance treaties already include anti-avoidance rules, there's unlikely to be trouble on that front. But what if all countries start enacting similar tax laws? Where will MNCs hide then, and who pays the cost of higher taxes? In Mumbai, Ayush Elavadi.
Well, that's the Google tax. Now, before we go, we have a special feature for you. Some have called it the case that saved Indian democracy. Others say it preserved the idea of India. The Supreme Court's decision in the landmark Kesavananda Bharati case said the basic structure of the Constitution cannot be altered. It was heard by a 13-judge bench, argued by legal luminaries like Nani Palkhiwala, T.R. Andhyarujina and H.N. Sirvai, and won by a wafer-thin majority. Last week, Supreme Court Senior Counsel T.R. Andhyarujina shared his views on the case as the first of a great cases series presented by the Vidhi Centre for Legal Policy.
Now, poor Kesavananda Bharati was a small figure in Kerala. He had some lands, and those lands are under reform. And the Kerala Land Reform Act would have been challenged and would have been struck down by the Supreme Court like Golaknath. So they appointed a sort of a committee to overrule this judgment of Golaknath. So they asked the Supreme Court to constitute a large bench. And the Supreme Court readily agreed. Says we will constitute the largest bench of 13 judges, and then this committee of the government said, but we must see that we have the right judges. Regrettably, they screened the new judges who are coming. There was the Justice Dwivedi, the chap who came from Allahabad, who said that I am going to reverse Golaknath. So he told Mr. Palkhiwala, supposing I procure for you an amendment of the Constitution for the right of property, and I guarantee there will be no other amendment, will you accept it? So Palkhiwala said, I was aghast at knowing the differences between the Attorney General and Sirvai. The other side exploited it. Once in a while, when Sirvai got up to contradict Palkhiwala, Hirandi got up and said, I don't agree with Mr. Sirvai. Second time they said the same thing. Palkhiwala said, yes, I agree with the Attorney General, not with Sirvai. So there was a lot of tension. Now Justice Sikri played a great stratagem, you might say even a trick. He brought out, all the judges read their judgments. Then he brought out a piece of paper, and on the piece of paper he says, the view of the majority. And he said the view of the majority is that the amendment cannot destroy the basic structure of the Constitution, which he took from Khanna. The basic structure is an architectural expression. What is part of basic structure? Nobody quite knows.
You can watch the entire commentary on our website, thefirm.moneycontrol.com. Great Cases promises to be an illuminating series, and we are delighted to partner it. Thanks very much for watching, and we'll be back with The Firm next week.
The Firm, India's only show on corporate law, tax and audit matters.